G'day there, welcome to the closing bell on the 9th of April. Today I'm going to keep on the theme that I've been following for the last few weeks of looking at those US 10 years. I think it is important to really understand, well, how important the market is itself and the fact that we're at a bit of a crossroads. We've had an announcement during the week from the Fed, from the speakers for the Fed. The way that they run things is that they'll get one of the governors or whatever to do a speech, well before they actually make an announcement, sort of hinting at the direction they're going in. And the hints we've received this week that they're considering rolling off that balance sheet, of lowering the size of their balance sheet. And that means that they won't be stepping into the market and buying, across the curve, in the yield curve over there, with printed money, holding down their rates. So that caused a big spike in the US 10 years. We've been following that quite closely, but I'm going to just recap it for you, just so that you're prepared for what could be coming next. If they do really spike higher, those yields in the 10 years, stocks will sit up and take notice. And the S&P 500 is looking a little dangerous. I've been setting you up for how things could play out for quite a few weeks, and things are starting to shape out as expected. So I want to update you on that. And we also saw a big spike in failure in the Aussie dollar. So I want to show you the setup there, because that is looking pretty interesting. I think the Aussie dollar is probably going to soften off from here. All right, well, let's get to the charts. This is the US 10-year bond yield chart. And just to recap, when the yield is falling, the price is going up. So when this chart is going up like this, that means the price of those bonds is actually falling. So that's important that you know that for starters. And really, when you look at this chart, look, it's an amazing chart, just how steady it is. You see how clear this channel is. And this is going back, nearly 40 years. And what we're seeing here is a generation of asset prices going up, isn't it? So after they killed inflation the last time, took rates very high, killed the economy, killed inflation. But from there, it's been a long, slow grind down in yields. And with each wave down in yields, there's another wave up in asset prices. And, that has been going on a long time. And now we've got to the point where US 10-year bond yields got to nearly zero, which seems a bit insane to me. And now inflation has taken off, and the Fed is now chasing down inflation. So you've got negative yield really on those 10 years for now. And how long will you have those negative real rates if inflation's at 7-8% and you're only receiving 2.5% on those 10-year bonds? And now the Fed's coming out and saying we're not going to buy those 10-year bonds with printed money, and we're even going to let the ones we own just roll off, and who knows, potentially sell some of the ones they own. Probably not, but if they came out and said that, you could imagine those bond yields would really fly higher. So it's an intriguing point in the market, and I just want you to note, as this trend develops, how I look at things is the key wave down. We're looking at the reaction that happens against that wave as a percentage reaction. That's what those Fibonacci levels that we look at, where we're looking at the major wave down, and then we've got the reaction, which goes up often to the sell zone of the previous wave, but often to the midpoint. So just to show you where we are now, if we're just looking at these previous waves and figuring out where the yields go to, you can see that on this wave down, 1997 down into 2000, the reaction we saw went really close to the sell zone of that whole wave. Then we had another wave down. Now, where did that go back to? You can see rates pulling up around that midpoint, the point of control. And pretty much that story has continued. You've got this next wave down, and the midpoint is where those rates pulled up. So it's just a very important thing to understand that this is, a generation of rates falling, a generation of this downtrend continuing. And when the downtrend is under threat is when rates go above the lowest high in the yields. And it hasn't happened yet in, 4 decades. So the most recent lowest high is from that region there, and that was around 3.2, 3.3%. That's a very important point in this move in US 10 years. So rates going above there is not only breaking out above the channel, so we have this very long-term channel going on, and rates right now, after that Fed announcement this week, have cracked up through that channel, and there's no sign that the rates are going to drop anytime soon. There's no sign that the selling has finished. So what happens if rates do just go in a straight line up through that 3.3% region? That's going to be pretty interesting, and stocks will not like that one bit. So you've got to be aware that that's the point we're at. We need to see some support coming in for these yields at some point, because otherwise stocks are going to take fright. And if I do just look at the most recent wave down in yields, you'll remember I've written plenty of articles pointing out that the area I'm interested in, where I think rates can get to, is that sort of 2.5 to 2.9% region, and that's where we're heading to. If you've been watching these videos for a while, you'll remember all the way back here. I was saying if we broke up through that 1.8% region, it should be a pretty quick trip up through to 2.2%, and there's not much resistance in yields up until this sell zone, 2.5 to 2.9%. So we are now racing up into that area, and we've just had word that the Fed is backing off and wants to shrink their balance sheet, so they won't be supporting the long end of the US yield curve as they have been in the past. So the situation is ripe for these rates to actually keep going. And that's what we need to watch in this next period. What are those rates going to do? Is there going to be big selling pressure, for example, from the risk parity funds that are long stocks, they're long bonds, they're very leveraged up, and they own a lot of the bonds. Over time, usually stocks go up means bonds go down, or bonds go up means stocks go down. So they're making money over time based on that strategy. Now, when they come a cropper is when both bonds and stocks start falling, because they're leveraged, and they're very leveraged into the bonds. So at what point do they really get forced to deleverage, forced to sell out? And we have had the biggest sell-off for 50 years or more in that last quarter in bonds, and that's worldwide. So there would be a lot of losses out there, and as the selling accelerates, it can create more forced selling. So the situation is there for this to now start to surprise the market in the way that the rates move. Obviously my expectation is that somewhere around here, the buying will step back in. And even if we are heading higher in the longer term, that there should be a period of rates coming back off, which could support stocks. So this is the area where I'm, interested around this 2.9% region, but there's just no signs it's stopping yet. And I'm interested to see what happens if it cracks above that lowest high in that channel from the last, 4 decades. So we're certainly entering a very interesting period going forward. You need to understand and that big picture of where we're at and the fact that things could become a little bit disorderly going forward in that bond market, and that will ultimately affect the stocks. So let's move on to the S&P 500 quickly, just to give you an update. So here we have the S&P 500. And again, if you've been watching these videos, I've been preparing you for the fact there should be selling pressure up here, saying last week, if we get the weekly sell pivot from here, it's going to look interesting. So let's have a look at what's happened this week and get a sense of what's going on. Now, you will know more than me what happened on the Friday evening in the States, but I'll just show you what I'll be looking for to get me a little bit more bearish. So this is the correction that we've had from the highs. This is the weekly chart. We can see that the weekly trend is down, 10-week exponential below the 20-week simple. And look, the way these things move is you've got these long-term sort of moving averages to give you a sense of sort of how it evolves. You have these long-term movements, and then you've got the shorter-term movements within that. So once you have, let's say, the long-term turning down, you'll then have volatility, short-term volatility going up, and you're trying to find that point where the short-term volatility goes from up to down and rejoins that long-term downside momentum. And the way I could explain that is showing you just here a little indicator I have, which is showing the slope of the 20-week moving average and also the slope of that 10-week exponential moving average. So there you're seeing the longer term and the shorter term impulsive moves. So the point here is that the long term has turned down. So the slope of the 20-week moving average is now down. We've just had a short-term upward impulse. So that 10-week exponential moving average, the slope's just moved up slightly. So now if it turns down and heads back below zero, that is the point when you can get really impulsive moves to the downside. So if we just look back in the past, just to give you a sense of how these things can evolve, you'll see during the crash, when you've got the long-term moves down, you then have these short-term impulsive moves to the upside. And if it then turns down and rejoins that longer-term weakness, that is where you're at the beginning of what can be quite explosive moves to the downside. And you'll see it again here. The long term turns down. The short term goes up into like a short squeeze. Then once it turns down again, that's the point when you get really big sell-offs. So it's just now at that point where we have the long-term already starting to turn down. That's just on the weekly, not on the monthly. But the situation is such that the weekly sell pivot turning up now, and you can see on the Friday, we're on the edge of creating that weekly sell pivot. Close below 4,500 in the S&P futures will create the weekly sell pivot, and especially below that 10-week exponential, and that's at 44.61. So if Friday night was a bad night and closed down there, that really is a bit of a sign to say, watch out from here, that short squeeze may be over. And remember, we did get confirmation that the wave to the upside retested the bottom of that sell zone of the whole wave down. So it's ticked that box that where I expected the selling pressure to be, it is there. And not only is it there, if it's creating the weekly sell pivot and especially turning back down below that 10-week exponential, it may take a while for it to take shape, but that's just enough of a sign for me that you've now got to start watching out, because it's, I guess, ready to do that next leg. And that next leg can either be quick, or it can take time and stuff around for a while. But it's just, the situation is now there. And it's taken quite a while for this situation to develop. And we have those bonds in that very interesting spot where the Fed's backing off, wants to lower the balance sheet, doesn't want to support the market as they have, and the rates are at the point of breaking out above a channel of that is 4 decades old. So it's just an interesting time, and I think it's one where you do need to understand the situation so you're not too surprised if things do get a bit out of hand at some point soon. So I'll just finish off looking at the Aussie dollar, and I'll start by looking at a very long-term chart so that you can get a sense of what's going on here. We've got the downtrend that's occurred for the past decade. You can see there, and if you just look at the waves, you'll see that it's all still intact, that downtrend. And when I'm looking at these waves, I'm going in and looking at the most recent wave to the downside. Then I'm looking at that sell zone area as the spot where I expect to see resistance. And I did talk about this at the time when it sold off. So we've seen the resistance where you'd expect it, being around that 80-cent region, and it sold off there for months going into 2022. And you can see it got down nearly to that point of control around 68 cents. But we've had a rally. So let's go in nice and close so you can understand what's going on here and why I think the Aussie dollar could be in trouble going forward. We're looking at the big picture, and we've seen things turn down where we'd expect it to. The long-term trend has actually turned down, and even though it's rallied from 70 cents to 76 on the back of the strong commodity prices, remember our rates are lagging way behind the US, and they're expecting a lot of rate rises this year. We're not really sure what Australia is going to do, but they're dragging their feet. So potentially that interest rate differential is going to really blow out. And does the Aussie dollar deserve to be as strong as it is at the moment? And it is now, retesting up into that sell zone once again. And you can see that just this week, it's really had a strong bashing from within that area, getting hammered back to the bottom of that sell zone. So if we look up close at the weekly, you'll see that the most recent move has just been a little false break, hasn't it? Where it's tried to rally above that level, it's met the selling pressure and is being hit. So my view would be that the Aussie dollar is going to struggle here for a bit and could sell off in a much bigger way than many expect from this area. I'm just looking at that most recent wave to the downside over the past year, and you'll see it didn't quite make it up to the sell zone, but it nearly did. So that's the area where you'd expect some selling pressure to come in. So even though we haven't got the weekly sell pivot yet, I wouldn't be surprised if next week was that weekly sell pivot. And it is just an area where this could be the beginning of a much bigger sell-off in that Aussie dollar. It's just looking pretty ripe. So, back above 77 cents, I'd sort of go off that view if it managed to turn straight back up. But the way I'm looking at it, I reckon that Aussie dollar is probably going to come under a bit of pressure going forward. All right, well, that's enough for this week. A lot of things to think about there. We've been talking about them for quite a while now, and it's all sort of starting to take shape. So it'll be interesting to see how markets perform over the next few weeks. All right, well, I hope you enjoyed that. Definitely sign up for Money Morning if you haven't already. The links will be below the video. But also check out my services that I'm running if you want to join in. That's Australian Small Cap Investigator, Pivot Trader, and now Fat Tail Microcaps, which we've just set up, where I'm trading really the smaller stocks on the index. All right, cheers. That's enough for this week. I'll come back with more next week. Cheers.